depreciation recapture is if you have an asset that's not depreciable. That's really it. So
Okay.
if you have land or if you buy something as an investment property, then that's something that you're not going to put through a normal depreciation schedule. But if you're using it for business, the IRS rule is either the depreciation that you did take or could have taken. So that's something to be aware of. If you have a rental property and you have renters in there, but you're not taking any reasonable depreciation, and then you go to sell it, there's a possibility that you may have lost out on a tax deduction because instead of taking that depreciation that whole time, you go to sell it and you're going to have a gain, and the IRS is going to say, well, your gain is not what you sold it for minus what you bought it for. Your gain is what you sold it for minus what you bought it for minus the depreciation you should have been taking. So that's something, especially if you have a piece of rental property or something that you bought that you just didn't include in your depreciation schedule but should have. That's something you want to get with your tax advisor as soon as possible and before you lose out on the opportunity to go back and take those deductions. Kind of exchange was a way that you used to be able to avoid, not avoid, but postpone that depreciation recapture. So you would be able to wrap the value of the asset into another one, and whatever built-in gains you would have would then go with that new asset and would continue to be delayed until you sold that new asset. You can still do that with real property. So with a business building or a rental property, you can still do that. But you can't do that with a vehicle anymore.